Hey there. Imagine you're at a carnival. You've got a big bag of popcorn in one hand and, for some reason, a giant inflatable hammer in the other. You walk past one of those whack-a-mole games, and next to it is this guy. We'll call him Bob. Bob's wearing sunglasses, chewing gum like it owes him money, and absolutely destroying the game. Every hit is perfect. The lights flash, sirens blare, tickets shoot out like confetti. You're impressed. Bob grins at you and says, "Dude, I got the pattern. I know where the mole's gonna pop up." Now hold on to that image of Bob because we're about to talk about the stock market. A lot of people think they can be like Bob, see the pattern, beat the system, and walk away with a fat stack of prize tickets, aka money. But here's the kicker. The stock market isn't a game with moles that pop up in the same order. It's more like a game where the moles don't even know when they're going to pop up, and yet, people try to beat it every single day. So, what does that actually mean? Beating the stock market? Well, first, let's define the market. Most of the time when people say that, they're talking about the S&P 500, which is basically a collection of the 500 biggest companies in the US, kind of like the stock market's all-star team. If you just invest in the S&P 500, you're basically betting on the overall US economy doing well over time. Historically, it returns about 7% to 10% per year, adjusted for inflation. So when someone says they want to beat the market, what they mean is, I want to make more than that, consistently. Enter Alice. Alice is your cousin. She got really into investing after watching one TikTok video that used a lot of neon text and aggressive dubstep. Now she's glued to candlestick charts, sipping oat milk lattes, and telling you about bull flags and Fibonacci retracements. Alice doesn't just invest in the market. No, she's trading, she's picking stocks, she's moving fast. And last week, she made $500 trading a biotech company she heard about from a guy named Crypto Kev. Alice thinks she's beating the market. And hey, maybe she is, for now. But here's where things get interesting. You know what percentage of professional investors, like actual hedge fund managers in expensive suits with Bloomberg terminals and assistants named Chad, actually beat the market over time? About 10% over a 10-year period. Yep, only 1 in 10. And that's with teams, algorithms, insider knowledge, legally obtained, of course, and 47 cups of espresso per day. So if these guys can't consistently beat the market, how confident should we be that Alice can? Here's the secret no one wants to admit. The market is already priced for everyone's knowledge. It's called the efficient market hypothesis, which is a fancy way of saying, by the time you hear about a hot stock, it's already too late. Like imagine if someone yells, "Free donuts in the break room." You run over, but by the time you get there, Karen from accounting already took the last one, and a napkin. That's how fast markets move. Prices change based on information instantly. And you're not just competing against other Alices out there. You're competing against AI, hedge funds, and traders who've been doing this since you were in middle school learning what a mitochondria is. But hey, this doesn't mean you should give up, throw your hands in the air, and shove your money under the mattress. Because here's the twist. You don't have to beat the market to build wealth. Let that sink in for a second. You could just ride the market wave instead of trying to surf ahead of it. It's kind of like being on a travelator at the airport. You can walk really fast and try to get there before everyone else, or you can just stand there, hold your coffee, and still end up at the same gate as Alice, who's now sweating and out of breath. The trick? Time, patience, low fees. It's boring. It's not flashy, but it works. There's a reason Warren Buffett once made a $1 million bet that a low-cost S&P 500 index fund would outperform a group of high-powered hedge funds over 10 years. Spoiler alert, he won, and not by a little. The hedge funds did okay, but the index fund crushed them. So let's go back to Bob at the carnival. Imagine if the game randomly changed every 3 seconds. The moles could teleport, and sometimes they'd just lie to you about where they popped up. That's what it's like trying to beat the market consistently. Bob wouldn't stand a chance. And Alice? Well, last we heard, Crypto Kev vanished and the biotech stock dropped 30% overnight. Meanwhile, you bought the boring S&P 500 index fund, went outside for a walk, and your money just quietly grew in the background. like a slow-cooking stew that smells better every hour. But what if you really want to try to beat the market anyway? What if you think, well, I'm smarter than Bob and definitely smarter than Chad the hedge fund guy? Let's talk about that. All right, so let's say you're still feeling spicy. You want to take a swing at beating the market. Maybe not with all your money, but with some of it. Just to see if you've got the magic touch. The golden gut instinct. The trader's sixth sense. Cool. Let's talk about the 3 paths most people take when they try this. 1. Stock picking. This is the classic move. You find a company you like. Maybe it's something trendy like Tesla, or something boring but solid like Coca-Cola. You read a few articles, check out their earnings report if you're feeling fancy, and think, this stock is going places. Now, stock picking sounds easy in hindsight. Everyone's got that friend who says, bro, if I had bought Amazon in 2006, sure. But in 2006, people were saying Amazon was overpriced. In 2010, they said the same thing. In 2020, still the same. Picking winners ahead of time is hard, because every time you think, this stock is undervalued, there's a Wall Street intern 3 monitors deep with 40 spreadsheets who thinks otherwise. And even if you get one pick right, can you do it again? And again? And again? Remember, even professionals with 12 PhDs and a direct line to Janet Yellen's dry cleaner can't consistently do it. 2. Timing the market. This is the I'll wait until it crashes, then I'll buy approach. Feels smart, right? Like you're being careful, strategic, the lion waiting in the tall grass. But here's the thing. Crashes don't come with invitations, and rebounds don't wait for you. Studies show that if you miss just the 10 best days in the market over a 20-year period, your returns get absolutely wrecked. Like turn a nice vacation home into renting a storage unit wrecked. And those 10 days usually happen right after big drops. So trying to time the market is like trying to jump onto a moving train while blindfolded during an earthquake. 3rd day trading. Now we're entering the arena of Alice and her double-shot espresso fingers. Day trading is all about buying and selling in super short windows. Minutes, hours, sometimes even seconds. It's fast, stressful, and if you do it well, potentially profitable. But statistically, most day traders lose money, like a lot of money. And hey, if you really want to beat the market, there is one weird trick that works almost every time. Invest early. Time is the one thing even Wall Street can't hack. But that's a whole other story.